Scene script. Have you ever wondered why the UK's borrowing is less than expected? It's a question that's been puzzling economists. Let's delve into the surprising facts about the United Kingdom's borrowing situation. Official figures have shown that the government's borrowing for the first half of the financial year has been £20 billion less than expected. It's an intriguing situation, isn't it? But before we jump to any hasty conclusions, it's important to consider the bigger picture. While this decrease in borrowing might initially seem like a golden opportunity for pre-election tax cuts or higher spending, experts caution against such optimism. The reason? Rising government borrowing costs. Yes, my dear listener, as with most things in economics, it's never as simple as it first appears. Public sector net borrowing in September was £1.6 billion lower than the same month last year, yet it still ranks as the sixth highest September deficit on record. Furthermore, public sector net debt rose to an alarming 97.8% of GDP, reaching one of the highest levels since the 1960s. The government has experienced a bit of a respite due to a fall in inflation and an increase in tax receipts. However, economists warn that these positive factors may be overshadowed by the potential challenges of higher interest rates and weaker GDP growth, making it increasingly difficult to meet debt-cutting targets. So we find ourselves in a bit of a conundrum. On one hand, we have less borrowing than anticipated, an ostensibly positive development. On the other hand, we're confronted with concerns about rising government borrowing costs and potential economic hurdles down the line. In the face of the unexpected, we must ask ourselves, what are the reasons behind this borrowing trend, and what does it mean for the future? This is the question we will continue to explore as we journey deeper into the complexities of the UK's economic landscape. To understand the present, we must look to the past. The story of UK's borrowing is as intriguing as it is complex. Let's take a journey through time, back to the days when the Beatles were on the rise and the nation's debt was a fraction of what it is today. The 1960s, a time of economic growth and relative prosperity, saw the UK's debt at a manageable level. However, fast forward to today, and the picture is starkly different. The public sector net debt has ballooned to an astonishing 97.8% of GDP, one of the highest levels since those swinging 60s. A myriad of factors have contributed to this dramatic increase. A significant fall in inflation has played its part. Inflation, when kept under control, can stimulate economic growth. However, a decline in inflation can also mean less money flowing through the economy, leading to increased borrowing. On the flip side, an increase in tax receipts has also been a contributing factor. More money coming into the government's coffers would, in theory, reduce the need for borrowing. Yet, the reality is more nuanced. While more tax income can provide a temporary boost, it doesn't necessarily lead to a long-term reduction in borrowing. As we delve deeper into the past, we encounter warnings from economists, like echoes reverberating through time. They caution about the potentially damaging effects of higher interest rates and weaker GDP growth on the UK's ability to meet its debt-cutting targets. Higher interest rates can increase the cost of government borrowing, while weaker GDP growth can reduce tax revenues, both of which can exacerbate the debt situation. This journey through the annals of UK's economic history paints a picture of a nation grappling with the delicate balancing act of managing its debt. It's a reminder that while the figures we see today may seem daunting, they are the culmination of years of economic ebbs and flows, policy decisions, and unforeseen circumstances. With a historical perspective in mind, we can better understand the current borrowing situation. Now that we have the facts and the history, what are the implications of this borrowing trend? The potential impact of these borrowing trends on the UK economy and its citizens is multifaceted. On one hand, the lower-than-expected borrowing might seem like a positive thing. It could indicate that the government is managing its finances better than anticipated, which could lead to a stronger economy in the long run. It could also mean that the government has more room to maneuver when it comes to spending on public services or infrastructure projects, which could benefit citizens directly. However, experts caution that this isn't necessarily a cause for celebration. They warn that higher interest rates and weaker GDP growth could make it harder for the government to meet its debt-cutting targets. This could lead to austerity measures, which would impact the most vulnerable citizens the hardest. Furthermore, the rising government borrowing costs could limit the government's ability to invest in key areas such as healthcare and education. There are different strategies that the government could adopt to handle this situation. Some suggest that the government should take advantage of the lower borrowing to invest in projects that could stimulate the economy and create jobs. Others argue that the government should focus on cutting debt and reducing spending to ensure the country's financial stability. On the flip side, the lower borrowing could also lead to an increase in public sector net debt. This is concerning as it is one of the highest levels since the 1960s. A high level of public debt could put the UK's economy at risk, particularly if there is another financial crisis or recession. In conclusion, the implications of the UK's borrowing trend are complex and far-reaching. While it might seem like good news on the surface, it's important to consider the potential risks and challenges that could arise from this situation. The future is uncertain, but understanding the implications of the borrowing trend can help us prepare for what's to come.